That's good. You guys quieted down before I even asked you to. This got you getting trained, I guess, in this class. A couple of things before I forget. First is there's no class next Monday. It's a celebration of President's Day. I'm not even sure how exactly you celebrate President's Day, but I guess we go shopping, a big shopping day. Do whatever you need to do, but it's a long weekend. And because it's a long weekend, I've decided to go home. Home to me is California, which means I leave tomorrow morning and I don't want to come back on Tuesday for just one class. So next Wednesday's class is going to be a Zoom class. Okay. You guys like Zoom classes, I guess. Yeah. But somebody in the last class said, should I still come to the classroom to watch a Zoom class? My reaction is, are you out of your mind? It's a Zoom class. Do it in your pajamas at home if you need to, but I will send you the link. The link's out there already, but I will send it to you. The class will be a Zoom class. And it'll be interesting because I 350 people, which means the maximum number of people you can see on a gallery page in Zoom. It's 48. The reason I know it intimately is because I taught this class entirely online one semester, and you keep flipping gallery page to gallery page. But it'll be a Zoom class. The second is, I want to ask you whether you picked a company already, because I will assume from this point on that you picked a company and you've just forgotten to enter the name into the master list. I will let it slip for the moment, but I will keep an eye, and at some point I will email you saying, I notice you have no company next to your name. You remember the email addresses are there as well. Please go. So don't make me do that, enter the name. The third is, I know some of you are feeling a little overwhelmed because I do drown you in stuff, right? It's every day there's something coming at you. And you've kind of given up. You're saying, I'm not even reading this guy's emails. And the reason I say that is yesterday I got an email from somebody who shall remain unnamed saying, I'm in your class. I've been reading your emails. Is that enough for the class? Can I just read your emails and will I keep up with the class? I wish my emails were that productive. But I understand you have a life to live. You have other classes to take. I don't know why you take all those other classes, but you have other classes to take. I think you need the credits, not particularly for the learning, but you take the classes anyway, which means that, I'd love for all of you to be obsessed with this class, make it your whole life, but that's not healthy for you. It's not healthy for me. So I understand you have time constraints. So one of the things I'm going to send you in the email today is a list of what you should be doing depending on your time constraints. So I'm going to break it down into, I have a really full life. You're just intruding on my life. I want to spend as little time as I can, less than 3 hours, on top of the lectures, right? So less than 3 hours, including the lectures, means you really are not spending any time outside. I list out the 4 things you should do. You should do the post-class tests every session. It's about 10 minutes. You should review the lecture notes, which will take you about 30 minutes. No. And you should prepare for the quiz at least every 3 weeks or so. You should be spending, maybe at least take 4 quizzes. And then I go 3 to 6 hours, 6 to 10. And if you're really obsessed with the class and you're willing to say, well, who needs sleep? I have 15 weeks. I can spend every moment on valuation. I give you a full list of things to do as well. So be realistic about what your constraints are. If you feel you have limited time, spend it in the places where it makes the biggest difference, which means you're not doing evaluation of the week each week, right? Because if you have only 3 hours,
I want you to focus on getting the stuff that you absolutely need to. Do I think you're missing something with the valuation of the week? I think so. Otherwise, why would I waste, spend the time coming up with it? But I think there's a difference between what you want to get out of this class in terms of a grade and what you want to get out of this learning. You can get a perfectly good grade without ever doing a valuation of the week.
Now, yesterday I put up a Ramco, right? You don't value a Ramco. It's not like you can't do valuation. You can't answer the problems on the quiz. I do think it's good for learning because you learn, when you value a Ramco, what do you value? You're valuing Saudi Arabia, right? Why? Because 80% of Saudi Arabia's GDP comes from oil, and Aramco is the receptacle for that oil. You're not just valuing Saudi Arabia, you're making a bet on the House of Saud, right? Whether you like it or not, this is a joint bet on a country and a ruling family, because if any of those pieces breaks, your investment is going to break as well. So if ISIS takes over Saudi Arabia tomorrow, God help your Aramco investment, God help the rest of us on everything else. But you're seeing, basically, I want to do the Aramco valuation to illustrate there are some companies where the big questions you face are not about the company. They're about country and politics. How do I bring that into the analysis? So read that email, make your judgment on how much time you're willing to spend, then focus on the line items I suggest you should focus on given your time constraint. And if you have more time, of course, you can spill over into the other list. But don't end up spending your time in the wrong places and then find yourself unable to do the basic mechanics of the class, because that would be a pity. So with that long lead in, let's talk about cash flows and earnings. Today, we're going to leave discount rates behind, and I'm glad we will be. Because in discounted cash flow evaluation, I think I said this early on, we focus too much on discount rates and too little on cash flows. So today we're going to start the cash flow calculation. And you're going to notice that I start with a number that I get from a group that I've kind of besmirched their reputations all the way through, which is accountants. I've said some terrible things about accountants. I'm not going to take any of it back. But the truth of the matter is we are dependent on accountants feeding us a number that gets our cash flow calculations going, right? All cash flow calculations start with an accounting earnings number. Net income, operating income. And remember, you are valuing your company as of right now. So please don't turn in valuations as of January 1st, 2023. It doesn't help me in the least. Telling me that you'd have bought a stock on January 1st, 2023 is completely useless. You can't go back in time and do it. So you're going to be valuing a company on March 7th, April 15th, however late you want to put this off, but you're going to value it as of that day. You think, so what? If you're valuing a company on April 15th of 2023, you want your numbers to reflect what things look like on April 15th of 2023. Some of the numbers are going to get updated, right? Like what? Your T-bond rate. You should be using a T-bond rate from the start of 2023. On April 15th, there will be a T-bond rate, maybe even implied equity risk premium, because I'll update it in April 1st. You can use the updated premium. So the market-based numbers are going to automatically update. But you also need accounting numbers, right? Accounting numbers don't update every second of every day, every minute, or even every day. They update every time accountants come out with a new financial statement. In the US, that's once every quarter. So you want updated accounting numbers. The only problem is those numbers don't. And if you're stuck with annual reports, they update once a year. So given that we want updated earnings numbers, I'm going to ask you how to compute those updated numbers. And I'm going to give you 4 choices to come up with updated earnings for your company. So let's say you're doing a valuation right now, February, whatever, 15th, 16th, 17th, 18th, 19th. Yeah? You could take the last 10K. Have any of you checked to see what your last 10K is for your company? What is your last 10K? Which year?
2022.
You got 2022 already? Tesla has it. But for most of the companies I've checked so far, the last 10K I found was 2021. Many companies haven't come out with their 4th quarter yet, so you're stuck with 2021 numbers. If it's 2022, you're home free because that's the most updated number. So Tesla, you got lucky. But Aramco was September 30th of 2022. You can go with the last 10K and say, what choice do I have? But the last 10K for you might be 2021's 10K. You can multiply the last quarter's earnings by 4. You think that's a good idea? Technically, it makes a quarter into a year. What's the problem multiplying the last quarter's earnings by 4? Or seasonality, right? So basically, if there's seasonality and you're a retail firm and you take the third quarter and multiply by 4, I will not get a number close to my annual number. So don't do that. I can add together the earnings over the last 4 quarters. What's that called? It's called LTM, last 12 months or trailing 12 months. Basically, it's obtained by, which means for many of your companies, you're looking at October 1st of 2021 through September 30th of 2022. It's called trailing 12 months. Now, part of you saying, but my 10K is of April 15, 2023. You are being consistent. You know how you're being consistent? You're using the most updated numbers you can for every single input. And in the case of accounting, unfortunately, that input is going to be a lagged input. And if even that makes you uncomfortable, then you can try to fill in that quarter that's missing, get a forecasted number. The only problem with forecasted numbers is analysts don't forecast every item. You might be able to get this for earnings, but not for revenues. You're going to see me use trailing 12-month numbers as my starting point because you want the most updated numbers. And the reality is around the world, you will face different issues with trailing 12-month numbers. For some, the quarterly numbers are the standard in the US and in much of the world, but there are some parts of the world where we have only semi-annual updates. Some parts of the world where you don't get full quarterly reports, you get pieces being reported. Take what you can get update what you can, because your objective is to get the most updated valuation you can. Now, once you get earnings, you have to get from earnings to cash flows. And I'll give you the standard equation, earnings plus depreciation minus CapEx minus change in working capital. Here's where there can be an issue with what you've been taught in accounting and what we have to think about here. I'll give you the big definition of CapEx that accounting claims to estimate. A capital expenditure is any expenditure that creates benefits over many years. That's what I was taught my first class in accounting, that if you have an expense that creates benefits over many years, it's a capital expenditure. Now, I want you to think about whether accountants are consistent with their own definition of CapEx. And I'm going to give you a list of items, and you tell me whether they meet the big definition of CapEx and whether they meet the accounting definition of CapEx. Building a manufacturing plant, clearly. And there the accounting and the right thing match up, right? So if you have a manufacturing company, what you see as CapEx reflects true CapEx, the land, the building, this. Technology company, though, you have R&D expenses. Pharmaceutical company. Does R&D expense meet the big picture criterion for CapEx? Or the question I'm asking is, do companies do R&D to get benefits this year, or do you think they do R&D to get benefits over the future? It's like super CapEx, right? A pharmaceutical company that does R&D this year, if it's lucky, might get revenues 10 years from now. But what do accountants do with R&D? Screw it up big time. They're expensive. I'll talk about the rationale they use. It makes no sense, but they use it over and over. But I'm going to argue that because they expense R&D, the financial statements for technology companies and pharmaceutical companies are completely screwed up. The ripple effects that come from it. R&D is CapEx. It should be treated as CapEx. How about advertising for a company like Coca-Cola? You guys see the Super Bowl ads, right? You get these big name companies. Many of them are not advertising to go, Budweiser, Super Bowl ads since I don't know how long. They don't expect you to, maybe they do. Some of you might go and say, I need 6-pack of Budweiser right now. I just saw the ad. The reality is some of this is to build a brand name, to build an image that will pay off if you're lucky in long-term growth. You could argue that some or a big chunk of the advertising expenses for a consumer product company is really CapEx. And if you're a McKinsey or a KPMG, think of what your biggest asset is. What is KPMG or McKinsey's biggest asset?
It's people. Comes in at 8 in the morning, works till 10 at night or whatever it is. It's human capital, right? So you know what the analogous capital expenditure is? How do you increase your value? The recruiting and training expenses that you incurred for that human capital is really CapEx. What I'm trying to say is the accounting definition of CapEx was designed for the old time manufacturing company. And when it was built, every company was big time manufacturing. There were very few service companies. It worked fine in the 1940s and the 50s and the 60s. It is beyond getting frayed right now. It's just broken. Because you look at the 10 largest market cap companies in the world, there isn't a single manufacturing company on the list. Of the top 25, there's one manufacturing company that makes the list. The rest are service companies, technology companies, pharmaceutical companies, financial service companies. And in all of those companies, the accounting definition of CapEx doesn't match up to what we'd like them to estimate.
So we'll talk about what to do about that today. But that's the topic for today, is to get from, first get an updated measure of earnings and get to cash flows. So let's go back to, what the heck is that? Whoever that was, I hope they did not intend to show that, but because everybody now has it on their Zoom. Yeah. Okay. So we're talking about the cost of debt. Few last loose ends on discount rates. Let's complete them. What do we say the cost of it? Somebody repeat back to me what we're trying to estimate with the cost of debt. First, is it long-term or short-term? What they borrowed at or what they would borrow at right now? It's forward-looking. It's what you can borrow at long-term today. That's a cost of debt, right? So I'm going to introduce a couple of twists here in the cost of debt. You tell me what you would do. There are some sectors which get subsidized debt. Like what, green energy early on, governments often gave loans. Tesla in its early days got bonds that were below, that's what subsidized is. You have a market rate based on your default risk and you're allowed to borrow at a lower rate. Let's assume, that we have subsidized debt. Incidentally, to get to a cost of debt, you need default spread. So we'll come back to that. Okay? But basically we ended with synthetic ratings. That's where I left you off. And the synthetic ratings give you default spreads, and default spreads change over time, and you want the most updated spreads you can get. If you look at my website, you'll get the spreads at the start of 2023, but I'll also send you a link where you can check it at the start of every month. They update the spreads. Great site, free. That's always something I look for in a site. So I won't make you pay, but you can go in there and check. It's so you can get the updated default spreads, because they can change over a month, over 2 months. But I want to get to the subsidized debt question. Now let's take Embraer. Used to be a Brazilian government company. Now it's this global aircraft manufacturer. And Brazil was very proud about the emergence and growth of Embraer. It's a company that essentially became a global company from its Brazil base. And the Brazilian government, let's say, decides to lend to Embraer at a below market rate. If you remember, the cost of debt I had for the company was 9.25% based on, remember how we built up to, we started with a risk-free rate, then we added a default spread for Embraer and then a default spread for Brazil. 9.25% is the rate you would charge them based on their risk. The Brazilian government has lent to them at 6% below market rates. You're trying to compute a cost of capital to use to value Embraer. So this is a very pragmatic question. When you do your cost of capital calculation for Embraer, should you use the 6% cost of debt? Because that's what they're getting it at. Should you use the market cost of debt of 9.25%? Or is there some intermediate solution you would adopt that actually lets you get to keep your cake and eat it too? Let's take the 6 and 9.25%. If I use 6% as my cost of debt in perpetuity, I put it into my cost of capital. What's the danger that I expose myself to as an investor? What am I implicitly assuming about the subsidized debt? That'll be subsidized forever, right?
And we know subsidies kind of dissipate over time. Governments pull that. So the problem with using 6% forever is I might be understating my cost of capital even after it's become a more normal cost of capital. If I use the 9.25% as my cost of debt, what's the mistake I'm making? I'm missing the benefits I get from the subsidized debt, right? Because it is nice to have debt at 6% when you should be paying 9.25%. So in a sense, I've ruled out the two extremes, right? Is there a way I could use the 9.25% and bring the subsidy in? In other words, can I value the subsidy of here just separately? What would I do? But then I'd have two costs of capital, right? Or take a weighted. So that's one solution, is start with the 6%. As it scales out, move to 9.25%. Work through the cost of debt, right? Is there another?
I mean, if they break it down in their financial statements, you could maybe weight how much they get from government loans.
Which is a variation of the same theme, which is take the weights, change the weights over time. When you borrow money, forget about it, Embraer. Let's say your actual cost of debt is 9% and somebody lends you, let's say you have $100 million you borrow at 6% when you should be paying 9%. It's a 10-year loan. Is there a way for you to tell me how much that 3% subsidy works out as a gift to you? You should be paying what, 9 million a year as interest. You're paying only 6 million. You're going to save $3 million every year for the next 10 years. You take the present value of the 3 million over the next 10 years, you get a dollar value of the subsidy. You know, the advantage of doing this is once you have a dollar value of a subsidy, you can always ask, what does the government want in return for the subsidy? Trust me, governments never give things away without expecting something in return. There's always another shoe waiting to drop here. And you had, what do I have to do in return? I'll give you an example. I was valuing a sugar company in India about 20 years ago for a family friend. And sugar in India has the subsidy you get from the government. So you get these prices, they're higher than, and this is true around the world, US farmers get a subsidy. So I value the subsidy from getting that higher price. But in return for the subsidy, the sugar manufacturers are required to sell a portion of their sugar at below cost to a portion of the population that can't afford sugar. So I valued at the cost. And they were paying twice as much as they were getting as a benefit. They weren't aware. They thought of the benefit. We can't walk away. That's a benefit. And I said, you really can walk away because what you're getting as a benefit is less than the cost. But to do that, you've got to identify the subsidy, value it. So here's my solution. Use the 9.25% as your cost of debt. You're going to come up with the value of the company. You're not quite done. Then take the amount of the bank loan you have from the government. Take that loan, isolate the loan, and take the present value of the benefits you're getting just because, and then you'll make judgments. 15 years, the subsidy is going to go away. It allows you to isolate the subsidy benefits and present it separately from your valuation. And it's good as an investor to know how much of your value comes from the business and how much is coming from subsidy. Any questions on subsidized debt? Yes.
What you may have said this. What rate do you use to discount the?
You'd actually use your 9.25% rate because that's your true cost of debt. So take the 3.25% savings for the next 10 years, discount it back at 9.25% because that's your true cost of debt. What you get as a present value will then be the present value of the subsidy. Yes. I think in the case of things like green energy, green bonds, it's going to last until green energy becomes more the norm than the exception. So you are going to have to make a guess on that. The history of subsidies is they don't last for more than 10 or 15 years. So the subsidy might be for export-oriented companies. You know what? You're not going to get that forever. So it's usually for a finite period. It's usually a fixed loan. What makes it easier is the government actually has a term loan. Just use the term of the loan. Use that as your period of the subsidy. And assume after that term, you're not going to get re-upped. It's probably the most sensible thing to do in that. Okay. So we have a cost of debt that reflects the rate at which you can borrow money. So let me bring this all together for Embraer, because I've been talking about Embraer off and on. I talked about equity. We did lambdas for Embraer. So this was my cost of capital calculation for Embraer. Let me start at the top.
I made a choice to estimate my cost of capital in US dollar terms because in 2004, the Brazilian government did not have 10-year bonds in reais. So I basically had no choice but to go with dollar cash flow. So it was a choice. And because I made the dollar choice, the risk-free rates you're going to see are going to be T-bond rates, even though Embraer is a Brazilian company. So 4.29% is my T-bond rate. So that's the first choice. The beta that you see there, 1.07, is a bottom-up beta for Embraer based on global aerospace companies. If you don't remember that, we talked about that last session using global averages. So 1.07 is a levered beta for Embraer based on global aerospace companies. The 4% was the implied equity risk premium for the S&P 500, mature market premium. You're saying, where's Brazil? It's in that extra 7.89% premium. This was a time when Brazil was considered a very risky country. The country risk premium for Brazil was 7.89%. And I estimated a lambda that, because Embraer's risk, I was so worried about Brazil, I focused on Brazil. And this was the lambda I got by running a regression of Embraer returns against the C bond. Remember the Brazilian dollar denominated bond? Risk-free rate plus beta times mature premium plus lambda times country risk premium. If I'd not computed lambda, what would have been different? I'd use the beta, but instead of the 4%, I'd use a weighted average of 4% times the proportion. 97% of the revenues came from Brazil, 3%, I'm sorry, from US, 3% from Brazil. I could have used a weighted average, in which case there'd be no lambda. But it's a dollar cost of equity. The dollar cost of equity I have for Embraer is 10.7%. Everybody with me so far? Risk-free rate in US dollars, beta from a bottom-up beta, mature market premium being the implied premium for the S&P 500, the lambda and the country risk premium mopping up, bringing in the country risk. Let's move to the cost of debt. I'll come back to the market values in a while. Start with the same risk-free rate. As a general rule, when you do cost of capital, your starting point for both your cost of equity and the cost of debt should be the same. In other words, you shouldn't be using a 10-year bond rate for equity and a 30-year bond rate for cost of debt, same risk-free rate. Two default spreads, one for the country, that's a 4%, and one for Embraer, 1%. Remember, we got the synthetic rating for Embraer? Cost of debt of 9.29%. Brazil's tax rate is 34%, marginal tax rate. So I'm using that marginal tax rate to come up with the after-tax cost of debt. I've got a cost of equity of 10.7%, a cost of debt of 9.2%, 9.29% net of the tax benefit. That was based on the rating. If you remember, we computed an interest coverage ratio for Embraer in the last class, and then looked up the synthetic rating. I think it was A+ or A, or no. That was the default spread for the rating. Okay? Lots of moving pieces all coming together in one calculation. What's the last thing I need? I need weights. I'll state the first principle here. The weights in a cost of capital calculation should be market value weights. Repeat that again. The weights in a cost of capital should be market value weights. So I need a market value of equity and I need a market value of debt. Which one is going to be easier to get? It's a publicly traded company. Market value of equity, I just took the share price times number of shares. That is the 11.042 billion reais. That was easy. Market value of debt is really messy. You know why? Because most debt at companies is bank debt, which doesn't trade. If every company issued bonds, you could look up the bond price and come up with market value. But most debt, even in the US, a lot of debt is bank debt. You don't have a market price. So you know what bankers do, because there is no market price for debt. They wave their hands for a little while and they say, this is too difficult to estimate. We're going to use book value of debt as a proxy for market value. I don't have a problem in most companies doing that. But if you're doing Bed Bath and Beyond right now, you think there might be a difference between the book value of debt and the market value of debt? Which one's going to be higher? I mean, the book value of debt is probably going to be 4 times higher than market value because the market value reflects the fact they're probably not going to pay. So I'll give you a quick and dirty trick for converting book debt to market debt, even if it's not trading. You remember how to price a bond? Nod, act like you do, because if you don't, we're in big trouble. There's like 3 classes along the way. How do you price a bond? Somebody help me. You have the coupons, you have the face value. What do?
you take the present value of the coupons and the face value using a market interest rate, right? So if the market interest rate goes up, the price of the bond drops. I'm going to draw on bond pricing to revalue the book value of debt. So here's what you have. When you see debt on a balance sheet, that's like the face value of all the debt you have due, right? If you go to the income statement, you see interest expenses, like that's like the coupon you're paying on the debt. And if you dig a little deeper in the footnotes, you'll probably also see a measure of when the debt comes due. So let's assume that you take the debt. In this case, it was about 4-year debt. You could see that in the footnotes. The interest expenses were $222 million. That came from the income statement. The book value of debt of $1953 million came from the balance sheet. So I've converted their entire debt into a gigantic coupon bond. A 4-year coupon bond with a coupon of $222 million and a face value $1,953 million. I reprice the bond using the 9.29% market interest rate. What I get as a present value is $2.083 million. The book value of debt is $1,953 million, but in market value terms, it's about $2.1 billion. Not a huge difference, but I've converted book debt to market debt. It's not going to make a huge difference in this calculation, but you can see that by doing that, my weights become 16% equity, 84% debt, and my weighted average of cost of capital is 9.97%. So if you have book debt, you want to convert it to market debt. You can do it if you have the maturity for the debt, the interest expense, and the face value, which you should for most debt. And then using the current market rate that you got as a pre-tax cost of debt as the discount rate. So what does it mean? When will book debt and market debt be roughly the same for a company? What has to be true? Yes. Your book interest rate, right? If I take your interest expense divided by book value of debt and I get 8%, your market rate is about 8% as well, your book debt and market debt are going to be the same. If your book interest rate is 6% and the market interest rate is 8%, then the market value of debt is going to be at a discount to book value. Just like, in a bond, if the coupon rate is lower than the market interest rate, you're using exactly the same mechanics used for bond pricing to convert book value of debt to market value of debt. So all of these calculations, this is the end game. That becomes the cost of capital you'd use to value Embraer if you're doing a valuation in US dollar terms. Any questions? Why do you guys look shell-shocked? Is bond pricing that foreign a concept that you're going to say, oh my God, I've never seen this before? You probably, because you hit that yield to maturity, but it's a present value equation. So here's, if you want me to describe it in calculator mechanics, here's what you will do. Take 222 million, hit the payment button. If you actually have a physical calculator, if not the virtual calculator. So 222 million is your payment. N is equal to 4 years. Put in the 1,953 million as a future value, and then hit the present value button. You're going to get the number that I got. Try it out when you get a chance. Essentially, it's a present value problem that I'm solving, treating all of the debt as if. So you could compute, let's say you get there with your company, right? You will. You don't have to assume, you will get there, but even if I have to drag you there. Let's say you come up with a dollar cost of capital for your company. Why? Because you decided you wanted to do a dollar-based valuation. It's a Colombian peso company or a Brazilian company. So 4 weeks from now, you have a cost of capital for your company in dollar terms. And then you change your mind about currency. It's like a major deal, right? So in this case, let's assume I've got a dollar cost of capital Embraer. And I say, look, I want to do my valuation in nominal reais. I could go back and start from scratch, right? Come up with a new risk-free rate in reais, and you could end up with a cost of capital doing that. But I'll give you a much quicker way to convert your dollar cost of capital to real cost of capital. And it goes back to what we said about currencies. Why do risk-free rates vary across currencies? Differences in inflation, right? If the inflation rate in Brazil is 8%, the inflation rate in the US is 2%. Here's all you need to do to convert a dollar cost of capital into a nominal real cost of capital. Take 1 plus the dollar cost of capital, adjust for the inflation effect. That's a 1.08. Now, if you're in a hurry, you can just add the 6% onto your dollar cost of capital. You get roughly the same number. But if you want to do it right, You take the compounded effect, you come up with a dollar cost of capital of 16.44%. Get comfortable moving across currencies, right? Because all it requires is you take a dollar cost of capital, take inflation differences, play it out. And you can convert the cost of capital from any currency to any other currency. So my cost of capital had two ingredients, right? Debt and equity. And most of the time, for most of your companies, you're going to have debt and equity, but once in a while, you'll get what are called hybrids. You know what hybrids are? Hybrids are securities which are part debt and part equity. I'll give you an example, a convertible bond. Somebody explain to me what a convertible bond is and why companies might issue them. What is a what do you get with a convertible bond? Who's you? First, let's be clear. The buyer of the bond gets a bond. So if you keep the bond, what happens? You get interest expense, collect the coupon payments, face value, treat like a, but somewhere along the way, you can convert the bond into shares at a pre-specified conversion ratio. What has to be true about the stock price for you to do the conversion? Under what conditions would you convert? If stock prices go up or stock prices go down? In other words, those convertible bonds on Bed Bath and Beyond, nobody's converting, right? They become all debt. But if stock prices go up, you might convert into equity. The conversion option of convertible bond is equity. The rest is debt. So if you have a convertible bond, you can break it up into its debt and equity components, because leaving it as a hybrid leaves a mess, right? Because you have debt, you have equity, then you have a convertible bond, which is neither fish nor fowl. So if you have convertible debt, you can actually take the convertible debt, break it down into its debt and equity components. You know, how am I going to do that? Now remember what he said, like if you held the convertible bond, kept it as a bond, what are you going to get? Coupons and face value, right? Act like there's no conversion option. Value the convertible bond as if it were a conventional bond. You're going to get a fairly low value because the coupons are probably low, but price it as such. That's the bond portion of your convertible bond. The rest is all conversion option. Take it as equity. Your job in cost of capital is to keep it to two ingredients if you can. You don't want to add a third ingredient unless you absolutely have to. Because otherwise you create these illusory ways of lowering your cost of capital, which are really not true. So if you have a convertible bond, break it out and see what portion is equity, what portion is debt. I'll actually break it down mechanically and send it to you when I send my email after the class, so you can see how much of a convertible bond is debt and equity. There's another type of hybrid that gives me nightmares. I hate it. It's called preferred stock. Preferred stock in Latin America is really common stock without voting rights. So it's like, it's regular equity. Preferred stock in the US is like debt. But debt without any of the good stuff that comes with it. And let me explain why. In preferred stock, when you issue the stock, you set the dividend up front. So unlike equity where you get whatever's left over, preferred stock, I promise a 6% dividend every year. So it's like a bond, right? I've set the coupon rate. But here's the difference. When you pay interest on a bond, it's tax deductible. But when you pay preferred dividends, it's not. It's a stupid way to raise capital. And you know who issues the most preferred stock in the US? Banks. You know why they like it? Because it lets them win at the regulatory game. Banks are regulated based on regulatory capital. And for whatever reason, the regulatory authorities have decided to treat preferred stock as equity. So what it allows banks to do is issue debt and at the same time see their equity go up. The only problem is it's very expensive debt, right? Because you don't get any of the tax advantages. So those of you valuing banks, it is entirely possible that 10-15% of your capital comes from preferred stock. And if you have preferred stock, unfortunately, you have to open a third front in your cost of capital. There's debt, there's equity, there's preferred stock. The weights will all add up to 100%. But the cost of preferred stock is just your preferred dividend yield. Whatever the dividend is, divided by the price. So let's review. Cost of equity is a function of risk-free rates, betas, risk premiums. Cost of debt is a function of risk-free rates and default spreads. And if you have preferred stock, it's going to be whatever dividend you promise. The weighted average across the three becomes the cost of capital for your company. I promised you an email, but I actually did this. So let me show you how a convertible bond can be broken down. Yeah, this is actually a convertible bond with a face value of 125 million and a 4% coupon rate. Usually convertible bonds will have very low coupon rates because you're giving people a conversion option. The convertible bond is trading at 140 million, and you're trying to figure out how much of this 140 million is debt and how much is equity. Let's say based on the risk of the company and its rating, it should actually be paying 8%. Remember, the coupon rate is only 4%, should actually be paying 8%. So I took the bond, took the coupon, 4% of 125 million, the face value, discounted the cash flows back at the 8% rate, which they should be paying, and I get a value of 91.45 million. That is the value of the bond portion of the convertible bond. Remember, the bond trades at 140 million. You subtract the 91.45 million from the 140 million. What's left? The 48.55 million is the value of equity. I put the 48.55 into equity, the 140 million, the 91.4 million into debt. My problem goes away. I no longer have a hybrid to worry about. I've gone back to just debt and equity. That won't work for preferred stock, but at least for convertible debt, that option is there. Don't worry, most of you will not have convertible debt in your financials. So this is a very selective problem that some of you will have. Now, and if you do have it as a problem, just break it down, move it into debt and equity, move on. It's not, if you want to treat it all as debt, especially if the stock price is down, it's fine. Just move on, because this is just an ingredient in your cost of capital. So I did that review of cost of equity. Now let's talk about what goes into cost of capital. The cost of equity, of course, you said risk-free rate, beta, risk premium, you get a cost of equity. Cost of debt is a function of your default spread. That default spread would reflect the risk of the company if it's a developed market company, but sometimes can spill over into country risk, as you saw with them prior. The tax rate you're multiplying it by reflects the tax benefits you get from borrowing. And I'm going to introduce two different tax rates you're going to run into in this class and in finance that I want you to keep separate. The first is called an effective tax rate. The second is a marginal tax rate. The first is what you'll see in financial statements. You know, you open up Capital IQ, you open up your 10K, you'll see an effective tax rate. Somebody define for me how accountants compute an effective tax rate for a company. What is it? What does it measure? Yeah. It's basically accrual taxes divided by accrual in taxable income. So if you go to the income statement, they have accrual taxable income of 100 million, accrual tax of 20 million, 20 divided by 100 is 20%. Do any of you do your own taxes with TurboTax or any of the tax software? You don't have any income, so I guess it doesn't really make a difference. But you will one day have income and have to report taxes. Yeah. But one of the most depressing things about TurboTax is when you're done, just I think to make you feel pissed off, they'll say, congratulations. This year you paid 28.33% of your adjusted gross income in taxes. And here's what they do. They take your taxes paid and divide by, be glad if you get 28, but if you work in the New York area, it's going to be more like 47.53% or 56.22%. They take your taxes that are coming to you, divide by adjusted gross income. They're doing an effective tax rate. That's what an effective tax rate is. The average effective tax rate for US companies last year was about 18.5 to 19%. So that's effective tax rate. It's going to vary across companies. Some companies have single digit effective tax rates. Some have effective tax rates 23, 24, 25%. What's a marginal tax rate? It's a tax rate in your last dollar of income. It comes from the tax code, right? So somebody help me out here. If you're a corporation in the US, what does a marginal tax rate look like right now? What's your federal corporate tax rate? It's 21%, right? Plus you have state taxes, local. Remember, the US, you have multiple layers of taxes. And roughly speaking, it's about 25%. So you got an effective tax rate of 16, 17, 18%, a marginal tax rate of 25%.
The marginal tax rate of 25% is the same for every company which makes money, because you get to that 25% there's no tax bracket for companies, you hit that very quickly. When we do cost of debt, which of those tax rates do you think we are using? I mean, I gave you the answer, but why? Why do we use a marginal tax rate? You go back to turbo taxes. Let's suppose you have income. I don't want to insult you. Let's say you have $1 million in income. If that's still insulting, add an extra zero, right? You have $1 million in income and you have $100,000 in interest expenses. Tell me what happens in your taxes. You take the million, you subtract out the 100,000, you have taxable income of 900,000 on which you pay taxes, right? Think of where you saved on taxes. It wasn't on the first 100,000. It wasn't on the middle 100,000. It was on the last 100,000. That tax rate is going to be much higher than what you paid on the first 100,000, but that's the tax rate that you should be using for your after-tax cost of debt, because you save taxes at the margin. Apple's effective tax rate last year was about 15%. Why? Because there's a lot of foreign income on which it pays lower taxes than the US. But guess where all of Apple's debt is parked? It's all in the US, getting tax benefits at the 25%. So the tax rate we use to come up with after-tax cost of debt is a marginal tax rate. The weights are market value weights. But along the way, lots of little places where you can stumble and fall, right? In terms of risk-free rates and betas and risk premiums. So my suggestion is, take those big picture pages and work backwards. Think of this like a web page. You click and you go to a bigger page. Because you start with the detail, it's very easy to get lost. Think of the big picture of what you're trying to estimate with the cost of capital. Any questions on cost of capital? So let's talk about estimating cash flows. Did I get the right page here? So I'm going to first set the table here. There are two ways you can estimate cash flows. And this goes back to what we talked about very early in the class. You got to make a judgment on whether you're going to estimate cash flows to equity or to the firm. Free cash flow to equity is cash flows left over after debt payments. Free cash flow to the firm are cash flows before debt payments. I've set the calculations next to each other so you can compare them with each other. When you do free cash flows to equity, you start with net income. Why? Because you're an equity investor. You think about income from your perspective. It's equity income, net income. When you start free cash flow to the firm, you start with operating income. Why? Because you're looking at a pre-debt number. Net income is after. You subtract out the taxes now from the operating income that you would have paid if the entire operating income had been taxed. So basically, your starting points are different. Net income in one case, after-tax operating income in the next. With both cash flows, you subtract out what you're going to put back into the firm. And I'm going to talk about three items here that will go in. One is depreciation, that in a sense is cash available to you to cover your CapEx. There's CapEx, which includes what you're putting in for future growth. And of course, we have working capital. Think of that as investment in short-term assets to keep going as a company. That's the same in both cash flows. With free cash flow to the firm, after you subtract those, you're done. You got a free cash flow to the firm. With free cash flow to equity, you have one more step. Because you're an equity investor, you have to worry about cash coming in when you borrow money and cash going out when you repay debt. You're going to bring in the debt payments as a separate item. I want you to hold on to this page because as you look at the two calculations, look like you're doing different things, but you're actually doing the same thing, but to different claim holders in the company. So we'll go through each item because obviously what is CapEx, what is working capital, what is depreciation are items we've got to deal with, but that's the end game. So let's start with each of these cash flow calculations and set the process up. Each of the cash flow calculations, we're going to start with earnings number, right? Net income in one, operating income in the other, which means you have no choice but to be able to read financial statements. That's why at the start of the class, I said, if your accounting is weak, you're going to struggle with valuation because you're still trying to figure out what's the difference between operating income and net income. What's EBITDA as opposed to operating income? So get yourself comfortable reading a financial statement.
You're going to start with current earnings. And there I'm going to talk about a couple of things we need to do. Make sure you get the most updated numbers you can, and then clean up for your accountants, things that they might have misclassified. Second stop, you're going to stop and see how much the company is reinvesting back into the business. Of course, if you trust the accountants, you're going to look at traditional CapEx, land, building, equipment. But I'm going to argue, think wider. If you're a technology company, that R&D expenditure it's incurring is CapEx. If you're Uber or Netflix, what's your biggest CapEx? Where does your value come from? Having more subscribers, having more riders, right? So what's the analogous CapEx? How do you get those new riders? And it's a cost of acquiring new subscribers and new riders now has to become your CapEx. So we're going to talk about defining what you're going to reinvest. Do you have to reinvest though? Can a company choose not to reinvest? Yeah. But if you do that, what kind of growth should you give them? Either zero growth or negative growth, which is fine. So if you want to assume your company will not reinvest, I'm not going to stop you, but you better not be telling me a soaring story of 40% growth for the next 10 years while putting nothing back in the business. We're already starting the elements of preserving consistency when you tell stories. And if you're looking at cash flows to equity, you got to bring in how much are the cash flows from and to debt. Now, along the way, you're going to see multiple ways of getting to free, especially when you start working through past quizzes. You're going to say there are hundreds of ways of getting free cash flow firm. Not really. It's the algebra kind of working in different ways. I'll start with the traditional definition of free cash flow. After-tax EBIT plus depreciation minus CapEx minus change in working capital. So both those become your reinvestment, gives you free cash to the firm. If I consolidate those three numbers, I can call them reinvestment. I'm not changing the equation. I'm just consolidating what's being put back into the business in long-term and short-term assets. So when you see free cash flow firm minus reinvestment, reinvestment already includes working capital, acquisitions, R&D, etc. That's why in all my valuations you've seen so far, there's been only one line item. Look at the Aramco valuation. Look at the look at the valuation of Adani Group. There's only one line item. That line item includes CapEx, depreciation, working capital, all consolidated. I can even take the reinvestment and state it as a percentage of the after-tax operating income. So instead of telling you there's $100 million in after-tax operating income and I'm reinvesting 30 million, I can say I have a reinvestment rate of 30%. Am I changing the equation? No, I'm just restating it. So what I'm trying to say is when you see these different variants show up, they're basically trying to get to the same end game. I'm not giving you three different free cash to the firm. I'm still trying to get to the same end place. How much cash flow do I have before I make my debt payments? Oh, if you look at that calculation, one of the things that always puzzles people is I take the operating income and I act like I get taxed on the operating income. And I don't, right? I get to subtract out interest expenses. It looks like I'm completely ignoring the tax benefits of debt when I do cash flows. I'll take the looks like out of the way. I am ignoring the tax benefits from debt when I do the cash flows. Why am I able to get away with it? Aren't those real benefits? Because when I discount them back at a cost of capital. What goes into cost of capital? Cost of equity and an after-tax cost of debt. My tax benefits of debt are already in my discount rate. If I count the same tax benefits and increase my cash flows, I'll be double counting. 3 in 10 discounted cash flow valuations I see, double count the tax benefits from interest expenses. They just subtract actual taxes paid from operating income. You can't do that. If you're doing a cost of capital valuation, your cash flows should not include the tax benefits from debt. I can do the same thing with free cash flow at equity. Okay? You say free cash flow at equity, I could write the full equation out, net income minus reinvestment plus debt. But I can consolidate, right? I can take the CapEx, depreciation, working capital, and write it as reinvestment, and the cash flows from debt as a net debt cash flow. Or I can simplify even further. I can make that consolidated number, I can call it equity reinvestment. So if you see me or hear me use these words, the reinvestment is, I want you to step back and say, no, that reinvestment includes. So Don't ask me, where's the working capital change? Where are the acquisitions? It should all be consolidated in one number. We do it for convenience so that when we do projections, we're not projecting out 5 line items. We're projecting 1 line item. Now, before the class, what's your name again? Jason and I were talking about projections. He's actually way ahead in the cash flows. You should be a little jealous. He's projecting cash flows of the future. And he has, when you look at financial statements, he has lots of line items. He's doing a Chinese company, 10 line items, 15 line items. And as you project line items, you're going to pull your hair out because you're trying to project working capital, you're projecting a CapEx, you're projecting depreciation, you're projecting acquisitions, projecting R&D. My advice when you're projecting multiple line items, if you consolidate, you actually have a much better shot of projecting the consolidated item than each individual line item. I'll send you a link. I did this for Microsoft a few months ago just because I saw so much confusion in how people were computing free cash flows that I said, okay, let's take a company apart so we can see what the numbers look like. So this is from Microsoft. I'm not suggesting there's anything special you learn from it, but essentially to illustrate how we get from after-tax operating income to free cash flow of the firm. Okay, so let's start with free cash flow equity. There's my net income, green. There's my reinvestment. That's CapEx, depreciation, acquisitions. That's the chunk out of there's my debt cash flows, and there's my free cash flow equity. So you can see that my reinvestment in my debt cash flows went out of my net income to give me a lower free cash flow equity. When I do free cash flow of the firm, there's my after-tax operating income. There's my taxes. I'm sorry, there's my operating income. There are my taxes, my reinvestment, my free cash flow of the firm. Essentially, we start with earnings and work our way to free cash flow of the firm by looking at what has to leave the income before I get a claim on the cash flows. So as we go through this process, we're going to take each item and we're going to spend some time on it. What operating income, what tax rate, what CapEx, what depreciation, what working capital. But as you know, don't get lost in the details. Step back and think about what we're trying to do. We're trying to get to a free cash flow of the firm calculation. And all of these details are essentially helping us get there. You guys look like you're ready for a long weekend, so I'm not going to drag you through, but I at least want to get this process started. As I said, the first step in this process is accounting earnings. Now, this is where you're going to start your evaluation. You're going to start with an annual report or set of annual reports, and you're going to say, hey, what did this company make? I already talked about why it's so critical. Why it's so critical to update the numbers. Because you want evaluation as of right now, not 6 months ago, 9 months ago. So the updating part, and we talked about how to update, look, trailing 12-month numbers, But there are 2 other things that I think you might want to think about. The most profitable companies last year were oil companies. Made a lot of money last year, especially with trailing 12-month numbers. Why were trailing 12-month earnings for oil companies so high last year? Because oil prices between October of 2021 and September of 2022 were high. If I take those trailing 12-month numbers for an ExxonMobil or a Royal Dutch and let them grow at 3% a year from now on, I'm going to overvalue these companies. Why? Because oil is cyclical. It goes up, it goes down. Even in the last 3 years, it's gone from $30 a barrel at the peak of COVID to $100+ a barrel just a year ago. So what's the fix for it? One of the things we'll talk about with commodity companies is normalizing earnings, which is a nice word for, instead of using last year's earnings, I'm going to look at an average earnings over the last 3 years, last 5 years across the cycle. Not easier said than done. But normalizing earnings is basically a way of saying earnings go up, earnings go down. I don't want to build a castle on top of last year's numbers. The other, of course, is this accounting issue that I talked about, that accountants are not always consistent about the way they classify expenses. That there's one financial expense that they routinely used to categorize as an operating expense that finally, thank God, they fixed. What am I talking about? 2019 accountants came to their senses. Leases. I'm going to talk about why leases have always been debt. In the 30+ years I've been reporting numbers, I've always treated leases as debt. Starting in 2019, accountants seem to have joined me, which should make me a little nervous, but no, thank God they've come to from the dark side to the light side on this one. I'm going to talk about why I've always treated leases as debt. and why accountants have come to the same recognition. The other expense I'm going to talk about is an expense we just started this class with, which is R&D. Which is a capital expense, but routinely treated as an operating expense. So I want to spend the rest of this class talking about why we make those fixes and how it can change the way you think about a company. The updating earnings part, nothing magical here. If you can get 4 quarters of earnings put together. For some, you're going to get lucky because for many of you by next month, you should be getting your annual report. But for some of your companies, remember, year ends don't always have to be December 30th, right? If you're valuing, I think Disney is what, September 30th of each year. So if you have a company whose year end is September, God help you, because you're not going to get an annual report that reflects where you are now. You'll have to use the trailing 12-month numbers. But it's better to always use updated numbers to value your company. And the younger your company, the more critical it is that you update the numbers. Do you see why? Can a lot happen to a young company in 6 months? Absolutely. If you don't believe me and you're valuing a young company, take a look at the last 10K and take a look at the trailing 12-month numbers. Your revenues could have doubled or halved. Your losses could have quadrupled or become profits. Updating is not this minor issue. It can make a huge change in how you think about the company. So let's talk about the 2 accounting mistakes. The first is leases. I'll give you my rationale for why leases are debt. And then I'm going to expand the discussion because it's not just about leases, it's about any expense that looks like leases. And guess what? There are quite a few of those that you might have to factor in when you value a company. So I'm going to talk about how to convert an operating expense into a financial expense. Accountants do that for you with leases, but at least you can, I'll take you through the process. You can see it's not rocket science. The second is R&D. A capital expense that's being treated as an operating expense. I'm going to take you through the logic of why R&D has always been a CapEx, why accountants have mistreated it through its life, and what to do about them, bring them back. So let's start with leases. What makes debt debt? Sounds like a weird question, but humor me. What is it about debt that makes you treat it separately from equity? Go back to the basics. You have debt and equity. What is it about debt that you look for to separate it from equity? Yes. It's a contractual claim, right? So if you have a contractual claim as opposed to a residual claim, you're going to treat it as debt. So bank debt, obviously debt. Corporate bonds, obviously debt. Help me out again. If you sign a lease agreement, you're a retailer, you sign a 10-year lease at a store. Are you signing a contract? Oh, I think so, right? Is a lease, to me, that's the basis, right? If you have a contractual payment, it should be debt. So you're saying, why did accountants treat leases as operating expenses for as long as they did? They had this weird fixation on ownership. You know, let me explain what I mean by fixation ownership. They said, if you will not own the asset at the end of the contractual period, it's really not debt. Try using this logic with your landlord. You know, I don't really own the apartment, so I don't feel the urge to pay you every month. You're not going to be in the apartment very long. It's a stupid line to draw, but they used to divide leases into operating leases and capital leases. So if you had effective ownership of an asset, they would say that's a capital lease, we're going to treat it as debt. But if you don't have ownership, then it's an operating lease and we're not going to treat it as debt. We're going to treat it as an operating expense. That logic frayed at the edges a long time ago. You know when accountants realized they had a problem with leases? I actually found a panel, it was a brochure in those days, that would be a physical brochure that people sent out, about a panel discussion that was going to happen at the then NYU School of Business. Never know, it wasn't called Stern. On how leases should be treated as debt, 1949. 1949 is when accountants realized that a problem. When did they do something about it? 2019. That'll give you a rough timeline between when accountants realize there's a problem and something gets done, 70 years. What I'm trying to say is, if you think accountants are doing something wrong, don't wait for them to do it right. It might take until what, 22nd century? Just do it yourself. And doing it yourself is not a big deal. To convert leases from operating to financial expenses, here's what I need to do. I need to get your contractual commitments you've entered into. So I go through your contracts and this is how much, and you know what? US companies have been reporting that in the footnotes for the last 40 years. You take the present value of those commitments. That becomes your debt value. So I'm going to show it as debt on your balance sheet. So if you owe 100 million next year, 200 million the year after, I'm going to take the present value of those commitments. I'm going to treat it as debt. But balance sheets have this very unpleasant requirement, which is they have to balance, right? So if I take the present value of leases and treat it as debt, I have an unbalanced balance sheet, and I think you're going to have trouble getting it past the auditors. So to make balance sheets balanced, what do I have to do? I have to create a lease asset. It's called a counter asset. It's the balance sheet balance. And once I have an asset, what do I have to do in subsequent periods as an accountant? I need to write it off. It's like give the mouse a cookie time, right? Have you ever read this book? I used to love reading it to my kids. Give the mouse a cookie. I'll tell you the story because you look a little jaded. That's what happens. The mouse gets invited in, you give the mouse a cookie. And the mouse says, I want a glass of milk. Very demanding mouse. You give it a glass of milk, makes a mess. The mouse gets in the bath. The whole thing is just one thing on top of the other. This is very much like give the mouse a cookie. You thought you were done when you took the present value of lease commitment. Guess what? It's going to ripple effects. It's going to create an asset, which is going to create depreciation. Now you got to go back and restate your income statement because those lease expenses are no longer operating expenses. You now have a depreciate. You're saying, what a nightmare. But at least it's a repeating nightmare. It's exactly the same thing every single time. It's built into every single one of our valuation spreadsheets. We want leases, I'll convert it for you. I've done it for 30. It's basically the same process. But I'll give you an example using a real company so you can see how this would work out. So the gap in 2003. Okay. You know who has the most leases? I might have skipped that page. What kinds of companies do you think have this operating lease the most lease commitments? One is retail, restaurants, airlines sometimes, because depending on how they're classified, most airlines used to be capital leases, but some of them managed to get through. No. Shipping companies. So you can see that leases are not equally a problem for everybody. Technology companies, not a big deal, right? It's not like Facebook or Google enter into 15-year leases. So this is the gap. Big retail store at that time. Now a much smaller retail store, probably getting even tinier as you go through time. These were the contractual commitments that they showed in the footnotes. So what you see in the footnotes for a US company as lease commitments are not expected lease payments, they're contractual commitments. So 899 year one, and beyond year 5, US companies were required to show a lump sum. They didn't have to break it down anymore of commitments beyond year 5. So basically the gap said, but 1,000, I just split it up into 2 years because I don't think it's all going to come due. Here's all I did. I took those lease commitments, discounted them back at the pre-tax cost of debt. So in terms of sequencing, do you see why I had to do the cost of capital first? Because that gave me the cost of equity and the cost of debt. That pre-tax cost of debt becomes the discount rate. You take the present value of the lease commitments. What you get as a present value is $4.4 billion. I'm going to put that on the balance sheet as debt. If you thought retailers had very little debt prior to 2019, it's because you were trusting the accountants. Most of their debt took the form of lease commitments, and that debt was not on the books. I'm now bringing it on the books. So the $4.4 billion becomes debt outstanding, which almost more than doubles. It actually triples the amount of debt that the gap. That is the debt I'm going to use in my cost of capital calculation. But it's also going to mean that I've got to go back and redo my operating income. The operating income the accountants used to report used to be after lease expenses. And now I'm claiming, hey, those are not really operating expenses, they're financial expenses. The definition of operating income is before financial expenses. So add back the actual lease expense from this year, saying I shouldn't have subtracted out, but I have a loose end to tie up. If I've been treating leases as debt, there would be an asset which would be depreciating. I have to subtract. And I told you it's not a particularly pleasant thing to do, but at least it's the same thing over and over. Their operating income, if I adjust for leases, is closer to 1.36 billion. There's a shortcut you can use, which sometimes if you're in a hurry, you can go, but the shortcut basically takes the interest payment you'd have had on the debt and say, I should add that back because it's earnings before interest and taxes is operating income. I actually did this for the gap because their management was interested. At that time, the accountants were talking about how leases should be debt. At first, when the Gap called me, I said, do you know how slowly accountants act? By the time they get to it, it'll probably be a decade. I underestimated how long it'll actually take them. They said, we'd still like to know what our numbers will look like if leases are treated as debt. I said, okay. So I'm going to take you through the presentation I made to them of what would happen to their numbers if leases are converted to debt. And I'll tell you upfront that they went through various stages of delirium before coming back down to earth. So I said, okay, let me show you your actual numbers now and what the numbers look like with leases treated as debt. So the first column is what the accounting looked like in 2007. Their operating income, according to the accountants, was 1.012 billion. I said, that's not really true because you're subtracting out lease expenses. I'm going to capitalize lease expenses. Remember from the previous page and add, and add back that lease expense, subtract the depreciation. Your true operating income is 1.362 million. You can see people patting each other like, this is good. We're making more money than we thought. So, okay. So let the delirium build up. And then let the delirium build up even more. I said, if I treat leases as debt, then your debt on your balance sheet will go up. And they said, is this a good thing? Is that a bad thing? I said, people might be worried about that, but it's a good thing from your cost of capital perspective, because your cost of capital now will have a much bigger debt ratio and a lower cost of capital. At this stage, they're hitting the ceiling saying, this is great. Our earnings are higher. Our cost of capital is lower. Well, it's a great place to be in. And then I said, there's one small catch. The way we measure the quality of a company is by looking at what kind of returns you make on your invested capital. With the old accounting, invested capital included only conventional debt, and the return on capital they were making was 12.9%. But if I treat leases as debt and bring it into my debt, my return on capital drops to 9.3%. They said, what does this all mean? Will it be good for us, bad for us? It's a very simple metric you can use to see how leases will affect a company. Value comes from making excess returns over and above your cost of capital. What was the excess return the company was making before? 12.9% minus 7.31%, right? Roughly 5.59%. What are they making after the adjustment? About 3.05%. The net effect here was it lowered the value of the gap because it made them a less attractive company. I did this for Starbucks at the time, and this was when Starbucks was just going crazy. Now, this is when you didn't need Wi-Fi in New York. All you need to do was point your laptop and there was a Starbucks. At that time, Wi-Fi was cheap in Starbucks. There was one every block, right? You missed a Starbucks. There's one block further down. They were competing with each other. They'd gone crazy. But on a conventional accounting basis, it looked like they were making 14% returns. But this was a company growing by putting leases in the middle of the most expensive real estate. You converted the leases to debt, their 14% became 7%. And that was less than the cost of capital. It took 3 years for Starbucks to realize they were opening stores in places they shouldn't be opening them in. They had to come back, shut down like 5, and they go through this cycle over and over again. It's not healthy to not recognize how much you're investing. And that's exactly what you're doing when you don't capitalize leases. If you don't know how much you've borrowed, you're going to do some really stupid things. And that's effectively what was happening pre-2019. So why, again, remind me again, what is it about leases that makes me treat them as debt? They're contractual commitments, right? You're going to make them in good times and bad times. Any of you valuing Netflix? Nobody's valuing Netflix. Some of you will. I know by the end, you'll have like 5 people valuing Netflix, because you wouldn't have picked a company. You'll be watching some Netflix shows. Oh my God, I've got to pick a company. You're going to end up picking Netflix. Turn on Netflix. It's not as bad as it used to be. You have this menu of shows, right? Some are original content. But you know, until last year, the most watched shows, this might still be true for Netflix. I think last year, the most watched show on Netflix was Friends, but 2 years ago until they lost the contract. Your most watched show on Netflix is not Stranger Things or, whatever the new show is. It's some old show. That's all. How does Netflix get the rights to these shows? In fact, they carried the rights to the Avengers movies until 3 years ago. How do they get the rights to these movies? they basically go to the original content provider, Disney in the case of Avengers, they enter into a 5-year agreement to pay $100 million every year for the next 5 years. In return, they can show the Avengers show. Contractual commitment. If you look at the Netflix footnotes, take a look at it. They'll have lease commitments, which are already converted, but they also have content commitments. They still have, I think, $15 billion in content commitments spread out over 3, 4, 5 years. I think we should be treating it as debt. It's exactly like that. One final example, and we'll end for the day. I'm a Yankee fan, not a Mets fan, Yankee fan. And 2009, the new Yankee Stadium got built. And I decided to take 3 of my 4 children to the game, the opening day in Yankee Stadium. This is going to sound sexist, but I actually took my 3 sons and not my daughter. I gave her a chance, but she said, will there be Dippin' Dots there? I said, I'm not taking you to Yankee Stadium and spending half the game looking for Dippin' Dots. I'll get you the Dippin' Dots at home. You just eat it here. You don't have to come to Yankee Stadium and look for Dippin' Dots. So I took my 3 sons and we get tickets in the bleachers, right? But no, it's opening day, it's a day game. And the Yankees come running onto the field. The home team always, is on the field first. And here's what I saw. I saw a guy called Mark Teixeira run to first base. And as he was running up, I thought about $23 million every year for the next 5 years guaranteed. And then I saw this guy called Robinson Cano run to second base. He was a relatively cheap debt. He had like 20 million for the next 3 years. And you had Derek Jeter go to shortstop. I think his was 26 million every year for the next 4 years. And then I looked towards third base and there was an imposter that day. The guy who was supposed to run out was a guy called Alex Rodriguez. He was owed $27.5 million every year for the next 10 years. On the mound was a guy called CC Sabathia. I think 18 million a year every year for the next 4 years. And behind the plate was Jorge Posada, 15 million for 3 years. This is a very sick thing to do. But then the game was done. I took the present value of the contractual commitments in the infield. Forget about the outfield. I came up with the total present value of $600 million in the infield. If you're a Mets fan this year, walk out and compute the present value of your commitments there and be glad they did not get Carlos Correa for 30 million for the next 10 years. But if you're a soccer fan and you want to look at PSG and the contracts they've entered into, this is more than just leases. It's contractual commitments and why you have to worry about them.
With these operating risks, Right. Right, and then this. How is it reflected in the discussion? Right, thank you.